if we actually do convert on a referred application, it's likely that this person has a good relationship with the person that referred them, or else they wouldn't be referring them in the first place, obviously, to be their neighbor, fundamentally speaking. And what we see in these situations is that the residents who are living in a property where they have friends who live at it will stay longer. And there's all kinds of industry data around that. We've never done any of these studies on our own because there's very conclusive studies done by the large real estate investment trusts and community managers, et cetera, where average length of stay increases when somebody's living in a building that they have friends who are living at, or family, or what have you. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to share 5 leasing tips for all of the multifamily operators out there who are looking to further optimize their leasing process. And downstream from that is reducing vacancy, maximizing rent roll, and therefore maximizing NOI. So we're going to talk about leasing here in this episode. I'm just going to kind of rifle out 5 very actionable tips that you can implement, whether you self-manage, whether you work with a third-party management company, whether you have, an in-house management team within your organization, all things that you can quickly use in your business to reduce your vacancy rates and to maximize your rent roll. So number 1, staggered lease terms should be a standard in your business, right? You should be offering staggered lease terms when leasing apartments. And this is especially true for the folks out there who own buildings in markets where the leasing seasons are very seasonal, right? And where seasonality plays a big role in the success of leasing. So for example, in the Northeast, which is where we operate, leasing traffic falls off a cliff, and therefore the rents you can achieve fall off a cliff once you get into the late fall months, into the early spring months. So we're talking like November to March, and really rough in the November to kind of February timeline, or December, January, February months specifically. So long and short, when you're leasing units, you need to be mindful of when those leases are going to expire. So if you're accepting an application for a resident who's going to move in on 11/1 and they're moving out 10/31, or if they were to move out, they would move out on 10/31, and then you have a couple months of vacancy before that unit is, or maybe you got 2 weeks of turn time, you got 2 more weeks of marketing to find a tenant, and then you're signing another lease in the future with a 12/1 start date. Like, you're setting yourself up for compounded issues into the future when you put a unit on that leasing cycle. So what I highly recommend to folks who are leasing units on non-optimal cycles is to offer a few different leasing timelines, right? So we have 6 months, 9 months, 12 months, 18 months, 16 months, 14 months, whatever, right? And this is a standard for the large multifamily operators out there who use dynamic lease or dynamic pricing software. This is a staple of the folks who are using actually spacing on I think it's RealPage. I think RealPage is the property management software that has an in-house dynamic pricing tool. But, for the folks who own 300 unit complexes in, Boston, New York, LA, whatever, these very sophisticated management companies use dynamic pricing tools to price out 10 different lease options for a tenant who's looking to move in. Now, if you're a smaller operation, just yourself, or you work with like a less sophisticated third-party PM, which I think most of the folks who are listening to this probably fall into that bucket, it's unlikely that you or your PM company has access to one of these pieces of software. So you should be having a conversation with your PM around, look, we're probably going to be marketing this unit, and I should say, we're going to be marketing this unit, and it's probable that the resident who's moving in is going to be on a tougher lease cycle, maybe a November 1 to a 10/31 cycle. So what we should do is we offer 6 months at a significantly elevated rate that compensates you for turnover if that tenant does decide to move out. Obviously you want to retain a resident for far longer than 6 months, but you could just at least offer that term with some significant increase in the lease term. And worst comes to worst, you do turn that unit over and that tenant does not renew, and then at least you're leasing that unit in a better cycle. Ideally, you've picked up enough incremental income along the way to pay for that turnover, and it's not the end of the world. But more realistically, you can offer maybe a 9-month term, a 12-month term, and an 18-month term, or something along those lines, to get you out into better cycles, better expiration dates, and price them accordingly. I think that you should price your longer term leases at slightly lower rates to incentivize people to accept them, right? If you're going to be a long-term owner of real estate, and this assumes that you are optimizing not for absolute maximum rent roll and therefore executing a capital event, but let's just assume that you are optimizing for low vacancy, low turnover, long length of stay, which is what you should be doing in multifamily, unless you are trying to, maximize a T3 or a T6 to approach a sale or a refi or something like that. Let's just assume that you want to do what's best from an NOI standpoint over a long period of time. Maybe you ought, incentivize for a longer lease term to get that tenant who moves in on November 1st to not just stay 12 months, but another 6, and that takes you out to, May of the next year or sometime in that time frame. And that puts you on a better cycle. So that's leasing tip number one is embracing staggered lease offers and staggered lease terms. Number two is you should be offering incentives to residents at the building that you are leasing a unit out for referrals. So for example, like we have a large 45 unit building in our portfolio. When a unit comes vacant there, we share that we are turning and leasing a unit with the residents at that property and incentivize them to provide us a referral to a qualified applicant. Basically the language is if an existing resident at the building provides us with a referral to an applicant who submits a qualified application and subsequently signs a lease with a start date that is within 3 weeks of submitting an application, we will reward you with a $200 Amazon gift card or Visa gift card. And we keep it separate from issuing them rent credits because we don't want to complicate our rent roll. It's just another line item on the P&L in terms of referral gift cards. And what that does is it helps to drive additional leasing traffic above and beyond just, posting a unit for rent. What it also does is creates really nice goodwill with the existing residents there because this is just not normal practice in the property management world. And the last thing that happens here is if we actually do convert on a referred application, it's likely that this person has a good relationship with the person that referred them, or else they wouldn't be referring them in the first place, obviously, to be their neighbor, fundamentally speaking. And what we see in these situations is that the residents who are living in a property where they have friends who live at it will stay longer. And there's all kinds of industry data around that. We've never done any of these studies on our own because there's very conclusive studies done by the large real estate investment trusts and community managers, et cetera, where average length of stay increases when somebody's living in a building that they have friends who are living at or family or what have you. So leasing tip number two is incentivizing referrals from existing residents at a building by offering referrals, or by offering incentives rather for those referrals. Number three is you should be rewarding for reviews from the existing residents at your PM company. Now, a little bit harder if you work with a third-party company who's managing scattered site. Doesn't really apply to those folks. But if you are if you're managing in-house and you have a property management company in-house that you run things through, you should be trying to, generate reviews for your property management company. But most specifically, if you are managing a branded property that has a Google business profile, so-and-so apartments, so-and-so flats, so-and-so whatever, and there's a website tied to that, this is a source of leasing traffic. It is a source of social proof for potential residents. And this applies whether you're managing this in-house or whether you have a third-party management company managing your branded apartment complex. Tenants, when they look up a apartment complex, the name of it, the brand of it, when they're scheduling a showing, are going to look at the reviews. Like that's a very standard practice. And it's important to be mindful of that and to care about what the reviews are actually going to be. So part of this process can look like, one, it's asking for reviews and incentivizing to get reviews after a resident has what is likely to be a good experience with the property management team. So this could be right after a successful move-in. They got their little welcome basket. They're in their new apartment. That's a great time to ask. It could be right after a maintenance request is satisfied and attended to in a very quick period of time. It could be, right after you do some type of CapEx improvement, whether it's like on the exterior or the common areas or whatever, and you've made the place a nicer community to live at. And what you should be doing is saying, you can ask for reviews, and just generally speaking, I think that's better than not. But if you really want to increase the likelihood that you'll get reviews, it's by offering some type of, again, very small gift card. $20 Dunkin' Donuts, Starbucks gift card, something like that, for a review, regardless of whether it's positive or negative, right? And I think that's the big thing is you can't pay for good reviews that violates the terms around, incentivizing for reviews. But most people want to leave a good review. They'd rather leave a good one than a negative one, just inherently speaking. And if you're asking for and incentivizing for a review right after somebody has a good experience, it's very likely that they are going to convert into someone who does leave a review and leave a nice one, especially because they're feeling happy about their experience, on top of the fact that, they want to do the right thing as it relates to getting, some type of quote unquote reward, even though you're not incentivizing for a positive one, you're just incentivizing for a review, period. Leasing tip number 4 is offering concessions for applications who convert to leases with an earlier start date. And this is fundamentally just offering incentives or concessions. And I think many of the folks listening to this are, understand this. But I think again, it's worthwhile to at least bring up. I think just simply saying X amount of dollars off first month's rent when you move in within 2 weeks of applying is just something that really does drive activity. And it's something that I think really helps to increase interest above and beyond just reducing the base rental rate, because it's time bounding this offer in some capacity and at least is driving a little bit more urgency. And this is something that we have been increasingly leveraging in our business as we lease units. Last thing is number 5 is offering longer renewals upon lease expiration at higher rents, but paired with concessions. So what we're solving for here is we want to be putting residents on longer lease cycles so that we are securing their tenancy for a longer period of time. Now, historically, if you were to do this, you would typically need to offer a slightly more compelling rent than the 12-month lease offer, right? So let's say it's 12 months a 12-month lease, and you're offering it at $1,500 a month. And in, the kind of market average understanding, however you want to describe it, is that if you were to offer an 18-month lease, for example, that lease would be at some discount to that $1,500 a month. Maybe it's a discount of 3%, which on $1,500 is $45. You get it at $1,455 if I'm doing my math right here. Yeah. And there's some little incentive to securing a longer lease cycle. Now, we want to also do that, but we also want to maintain, a decent base rent on our rent roll in case we want to refinance the property, sell the property, et cetera, right? We don't want to sacrifice too much of the base rent in exchange for longer lease terms with the folks who are living at the building. So oftentimes what we do is we offer a longer term renewal, but with some very immediate incentive, right? So in this example, we can say $1,500 for a 12-month renewal, $1,500 for an 18-month renewal, but we will give you $200 off your next month's rent or issue a $200 rent credit to your account. So while they're signing up for a longer lease term, the actual net rent is a little bit lower if we account for that incentive. And for a lot of residents, they like the idea that the next month they're going to be paying less and they kind of get that money today. And if they're on the fence over, yeah, I might stay here, I might move, I kind of like this place, I kind of, might want to move to be a little closer to here, whatever, and they're kind of on the fence, sometimes that little incentive pushes them over into converting into a longer lease, which we find to be pretty beneficial. Again, and that's assuming you're optimizing for long-term cash flow and NOI, and you're not trying to do something interesting behind the scenes with your rent roll to try to, optimize the property for a capital event. But long story short, those are my 5 quick leasing tips for everyone out there who's operating multifamily properties, and I'll quickly recap them. Number 1, embrace staggered lease terms and, different rent prices with those staggered lease terms. Number 2, offer incentives to existing tenants for referrals. Number 3, optimize for reviews and offer rewards for reviews, whether they be positive or negative. Number 4, concessions for leases that convert quickly after the time of application. And number 5, offering longer lease renewals at higher rents, but paired with immediate concessions. Very tactical episode for you guys. I hope you learned something here. And if you do, please leave the podcast a rating and a review. Helps the show get noticed by more folks, as I say every week, which is obviously our goal here. But again, thank you all for listening, and I'll catch you on the next episode.